Investing isn't a get-rich-quick game. It's about playing the long game and making smart choices along the way. But let's be real, everyone messes up from time to time, right? And if you're not careful, those mistakes can cost you. If you're serious about growing your wealth, you need to be aware of the common pitfalls that can derail your financial goals. Today, we're going to talk about 8 mistakes that every investor makes, whether they're new to the game or seasoned pros. Trust me, avoiding these will save you a lot of headaches and a lot of money. Number 1, lacking a clear financial plan. You wake up, check your portfolio and think, what was I even trying to accomplish here? If you've experienced this, you're not alone. One of the biggest mistakes investors make is not having a clear, actionable financial plan. Without a plan, it's easy to get distracted by short-term trends instead of focusing on long-term goals. Maybe you started investing because someone else made a fortune, or you threw some money into a few funds because it seemed like a good idea. But if you don't know what you want to achieve, you're just hoping for the best. And hope isn't a strategy. You wouldn't drive across the country without a map, right? The same goes for investing. To avoid this mistake, take the time to set clear financial goals. Whether it's saving for retirement, building a college fund, or growing your wealth, knowing your destination makes it easier to choose the right path. Number 2, misunderstanding true risk tolerance. Have you ever seen someone panic sell their investments when the market drops? They bought stocks without understanding their risk tolerance, and when the market dips, they freak out. If you've ever been tempted to sell in a panic, you know the danger of not knowing your true risk tolerance. Investing isn't one size fits all. Some people can handle market volatility while others can't. If you're stressing over every dip, maybe it's time to rethink your strategy. You don't want to sell at the worst moment just because you're nervous. Understand your risk tolerance. Are you okay with volatility, or do you prefer stability? If the market's ups and downs make you anxious, safer options like bonds or index funds may suit you better. Align your strategy with your true comfort level, not what you think you should handle. Number 3, failing to diversify and rebalance. Imagine putting all your money into one tech stock. At first, everything's looking good and your portfolio is growing. But then the company hits a rough patch and suddenly your portfolio is crashing. This is the danger of putting all your eggs in one basket. That's why diversification is so important. It's not just about picking the right stocks. It's about spreading your investments across various asset classes, stocks, bonds, real estate, and others. By doing this, if one investment falters, it won't drag your entire portfolio down. Diversification lowers overall risk and helps balance out the inevitable ups and downs of the market. But don't stop there. Regularly rebalance your portfolio to keep it aligned with your goals and risk tolerance. As markets and your personal circumstances change, so should your investments. Rebalancing ensures your portfolio stays on track and adapts to new conditions. Number 4, trying to time the market. Do you think you can predict the next market crash or the next big bull run? If you do, you're not alone. A lot of people try to time the market, buying and selling based on predictions about what the market is going to do next. But the truth is, timing the market is nearly impossible. Sure, you hear stories of people who got lucky by buying stocks right before a huge surge or selling right before the crash. But those stories are rare, and they often ignore the countless others who tried to time the market and ended up worse off. The market moves unpredictably, and no one can accurately predict the future. Instead of wasting energy trying to time it, focus on building a long-term strategy that doesn't rely on perfect timing. Stick with your plan and let the market do its thing. Over time, patience will pay off more than trying to chase the next big move. Number 5, chasing past performance. It's tempting, right? A fund or stock has performed well over the past few years, and suddenly it feels like a no-brainer to jump in. But here's the thing, past performance is no guarantee of future results. Just because something did well in the past doesn't mean it'll continue to do so. Investors often get caught in the trap of chasing hot stocks or funds that have recently posted impressive returns. But chasing performance like this is dangerous. Markets are cyclical, and just because a stock or fund has done well recently doesn't mean it'll keep climbing. What happens if it doesn't? You're left holding the bag, and your returns could take a hit. Instead of chasing past performance, focus on investments that align with your goals, values, and risk tolerance. Look for solid, well-managed companies or funds that make sense for your long-term strategy, not the ones with the best returns over the past year. Number 6. Reacting emotionally to market fluctuations. Do you feel anxious when the market dips? It's natural to feel a little uneasy when your investments start to lose value, but making emotional decisions can be a huge mistake. Many investors panic and sell when the market dips, only to miss out on the eventual recovery. When you react emotionally, you're likely making decisions that go against your best interests. The key to avoiding this mistake is to stay calm and stick to your plan. If you've done your homework and set a solid strategy, there's no need to worry when the market fluctuates. Think of it like a long road trip. You might hit a few bumps along the way, but you don't change course every time the road gets rough. Keep your eyes on the prize and don't let emotions dictate your decisions. Number 7. Ignoring fees and expenses. You might not see them on the surface, but fees and expenses can eat away at your returns over time. Whether it's high management fees, trading fees, or expense ratios on your funds, those little costs can add up. A small fee might not seem like much at first, but over years or decades, it could mean thousands of dollars lost. Take a good look at the fees attached to your investments. Are you paying more than you should? Opt for low-cost options whenever possible, whether that's index funds, ETFs, or just being mindful of trading fees. It's all about maximizing the money you keep in your pocket, not handing it over to financial institutions. Number 8. Focusing too much on short-term gains. It's tempting to want to see quick returns, but focusing too much on the short-term gains can cloud your judgment. Investing is about building wealth over time, not getting rich overnight. If you're constantly chasing the next big thing or trying to make quick profits, you might be taking on too much risk and ignoring your long-term goals. Take a step back and think about where you want to be in 5, 10, or 20 years. The key to lasting wealth is consistency and patience. It's not about jumping in and out of the market for quick wins. It's about building a foundation for your financial future. Avoiding these 8 mistakes can be the difference between successful investing and watching your hard-earned money slip away. By having a clear plan, understanding your risk tolerance, diversifying your portfolio, and staying patient, you'll put yourself on the path to financial success. Remember, investing is a journey, not a sprint. If you want to keep learning and growing your wealth, make sure you comment below with your thoughts, share this video with friends, and subscribe to the channel for more tips. Don't forget to press the bell icon so you never miss out on important updates. Your financial future starts now. Take action today.